Bitcoin is being revalued by artificial intelligence. Hi everyone, I'm Crypto Superfan here. A few years ago, whenever people talked about technologies that could change the whole world, most of the attention went to blockchain, Bitcoin, Ethereum, and the idea of a brand new financial revolution. But over the past few years, I would bet that when people talk about the technology changing the world today, the first thing that comes to mind is AI. Right? Exactly. It is the name everyone is talking about. At first glance, these look like two completely different stories. One about cryptocurrency, the other about artificial intelligence. But if you look a little closer, AI is not just creating a new wave of technology. It is also forcing the market to reassess the value of many assets. And Bitcoin stands out as a particularly interesting case. In the past, many technology companies were valued highly because they had strong code, powerful software, talented teams, and advantages competitors could not easily copy. But when AI makes writing code, building features, and creating digital products faster, cheaper, and easier to replicate, those advantages begin to fade. Many companies are now forced into a new race, the AI race, just to maintain their position. Weaker business models, meanwhile, are starting to lose traffic, lose revenue, cut staff, and scale down operations. Just look at giants like Google. After ChatGPT from OpenAI exploded in popularity, Google reportedly issued what people called a code red, because for the first time, their traditional search model faced a serious threat. Since then, Google has accelerated hard into the AI race, from Gemini across its ecosystem to AI overviews inside search. Chegg, a major education technology platform in the United States, has been hit even more directly. Before the AI wave surged, their full-year revenue in 2022 reached nearly $767 million, and in 2023, it was still more than $716 million. But as AI became more widespread and direct answer models began changing user behavior, Chegg's business declined quickly. Revenue dropped to $617.4 million in 2024, and to just $376.9 million in 2025, a 39% decline in a single year. In the fourth quarter of 2025 alone, revenue was only $72.7 million, down 49% year over year. In short, many technology companies today are pushing themselves hard to keep up with AI, investing more, changing strategies, even restructuring just to maintain their position. Ironically, this constant race shows that their position may not be as stable as it once seemed. Because when you keep running non-stop, there will be moments when you get tired, slow down, stumble, or even head in the wrong direction. And that is where the market starts asking a new question. What technology asset can truly stand firm? If the market once paid extremely high prices for things that could scale fast, like software, code, or digital platforms, then in the AI era, what stands out more is provable scarcity. And this is where Bitcoin becomes a very special case. AI can increase the supply of intelligence. AI can make code easier to copy. AI can make building products faster and cheaper. But AI cannot create more Bitcoin. At the same time, the value of Bitcoin does not depend on constantly launching new products, adding features, or defending a business advantage against competitors. Bitcoin does not have a chief executive officer who can be replaced. It does not have products that must constantly be upgraded to keep users. And it does not face competitors launching a better free version to destroy its pricing power. Its core strength lies in its fixed supply, something that cannot be printed and cannot be diluted by AI. That is what makes Bitcoin fundamentally different from the rest of the technology world. But why, in the eyes of many institutional investors, has Bitcoin almost been placed in the same category as highly volatile technology assets, especially since around 2020? The reason is that during many periods, when enthusiastic capital flows poured into technology stocks, especially high-growth companies, Bitcoin also tended to rise very strongly. On the other hand, when technology stocks and other risky assets were sold off, Bitcoin often fell along with them. On the surface, that classification is not entirely unreasonable. Bitcoin does not generate cash flow like a business, while its price volatility is extremely high, so it is often associated with speculation and the market's appetite for risk. But at a deeper level, Bitcoin is grouped into that category not necessarily because its nature is similar to a technology company. More importantly, it comes from the way institutions classify capital flows. In the eyes of many large funds, Bitcoin has long been viewed as a high-risk growth asset, almost like a highly volatile extension of the technology sector. However, there is something important to keep in mind. The way the market trades an asset does not always reflect the true nature of that asset. Something can move in sync with technology stocks, but that does not mean it is actually the same as technology stocks. In the case of Bitcoin, this largely comes from the way investors, especially institutional capital, categorize it as a high-risk growth asset. In short, AI does not directly make Bitcoin stronger. But AI is revealing more clearly what makes Bitcoin different. While many technology companies must constantly chase AI in order to maintain their advantages and survive, Bitcoin does not need to enter that race to protect its core value. Bitcoin does not need to enter that race to protect its core value. And because of that, the market is starting to look at Bitcoin in a different way. Not only as a highly volatile technology asset, but as a scarce asset with its own position in an era where everything is becoming easier to copy and easier to dilute. However, from my perspective, it is important to stay clear-headed. The fact that AI does not change the fundamental nature of Bitcoin does not mean it can be trusted blindly. After all, Bitcoin is still an asset that relies heavily on market belief. The world may ultimately not need Bitcoin the way many people expect, and if that belief weakens enough, Bitcoin could still fall dramatically, or even collapse. At the very least, at this point in time, Bitcoin remains a very high-risk asset with extremely strong volatility. It can rise very quickly, but it can also fall very deeply in a short period of time. So even if the story that Bitcoin is being repriced by AI sounds convincing, do not turn it into a reason to chase the market or invest impulsively. Investing in Bitcoin still requires a clear plan, proper risk management, and always being prepared for the worst-case scenario. Thank you all for watching this video all the way to the end. I wish you all disciplined and successful investing. See you again in the next video.